Good afternoon, ladies and gentlemen. and Welcome to the CENTRALNIC Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Ben Crawford. Good afternoon, sir.
Hi there, and welcome everybody. Happy to be presenting today our year-to-date September 2022 results. And so let's just start with our highlights. So first and foremost, our online marketing business has delivered 100% organic growth in the 9 months to date. And this is on top of the growth that got us recognized in the Financial Times fastest growing companies. I guess key for investors here is it isn't just a matter of driving top line growth. Our operating leverage has in fact improved dramatically. So if we look at the first 9 months of last year, our EBITDA represented 37% of our net revenue. Fast forward to this year, it's 48% of net revenue, like moving inexorably towards that very attractive 50% margin. Meanwhile, we've been busy doing other things as well as driving the business. Michael and his team have successfully refinanced. So we have paid off our loan, which was a 7% coupon loan, a bond issued in Norway, and replaced it with a syndicate of banks who are now loaning the same amount of money to us at 3.45% interest. So a vast improvement and extended maturity. And I guess one of the key things here is it's also a US dollar loan. So last year, our bond was actually denominated in euros, which meant there was a lot of complexity with hedging and so on. Obviously, nothing that actually worked against us. We paid exactly the amount that we always knew we were going to pay using hedging instruments, but obviously having a US dollar loan means that we don't even have to worry about any of that stuff. But that's not all we've been doing. We have also been continuing with our inorganic growth or acquisitions. We acquired a company called Aporia, part of our online marketing group. Fantastic business that will integrate very nicely and improve our margins in that area as well. And that we acquired for $11 million. And then post-period in October, we acquired a company called IPMC that manages domain names for brands on the west coast of the United States. And that was a $7 million acquisition. Now let's move on to our business profile, summary of what we do. So the company, between when we listed back in 2013 and 2019, this was our sole activity, and it remains a key activity and one that obviously provides a foundation for the rest of our businesses. And that is our online presence marketplace. So by online presence, we mean the basic tools to get a company on the internet: their name, their domain name, their website, getting their email to work, and then some other services like Office 365 and so on. And we have built a very successful marketplace by buying a number of companies which all sell domain names, but they had different suppliers and different customers. And by merging them together, we now have a comprehensive array of domain names. We have as many as any company in the world in terms of our supply side, and we sell upstream as well. So we have access to virtually every domain name in the world, all the country codes in all the countries, all the traditional ones like .com, .net, .org, and all the new ones like .xyz, .online, .website, and so on. and we sell them software to run their domain names. We sell them managed services to actually manage their domain names, and in at least one case of SKNIC, the country code for Slovakia, we actually are the supplier. We own that domain name and run that for the country of Slovakia. Now, that's on the supply side. On the demand side, our customers, we have again merged together the various businesses we bought into channels. And we have three key channels: the reseller channel, where we make domain names and the value-added services available to the biggest retailers in the world: Google Domains, GoDaddy, WordPress, the European leader Team Blue, as well as a long tail of 20,000 other retailers in all corners of the world. Then we are also a retailer selling domain names and value-added services direct to entrepreneurs in almost every country in the world. We have 250,000 direct customers like that. And then lastly, enterprise customers. So these enterprise companies, they're brands, and brands think about domain names very differently from everyone else. They're not looking at them for email or websites. They're looking at them as the trademarks of the internet. So in the same way that they would go to their IP attorneys and say, this is our brand, we want you to secure it by registering trademarks in every country in the world, they will come to us and say, this is our brand, we want you to secure it by registering the matching domain names in every country in the world. So this is our marketplace. We designed and built this, and it's delivering us some nice growth. But I guess the real key here is the underlying investment thesis, and that is this: these are recurring revenue businesses. They're actually subscription businesses. So for every one of our customers, for every one of our products, they have to pay us a fee each year to retain the usage of the services that we sell them. And if they don't pay us, then cyber squatters grab their domain names, their websites don't work, email doesn't work, and so on. So there's a extremely predictable recurring revenue stream that comes from these businesses. They're also incredibly sticky. So in this industry, only 2% of customers switch from one supplier to another in the course of any 1 year. And that's because of switching risks, costs, and complexities. So look, it's a fabulous business to be in, and there are additional opportunities for more acquisitions to build this into an even greater, even more global business. And we are doing that. But in 2019, we decided to diversify into a close adjacency, and that is online marketing. So the idea here is our online presence businesses. So your business, every tool you need to get online, and then the online marketing businesses provide you the services to get your customers to come to your website, because that is the main reason that people go on the internet, is to acquire customers. So whether they're a dentist, set up a website for people to book appointments, or they're a shop wanting to sell people shoes, or a restaurant just wanting to take bookings, the purpose of them being on the internet is to acquire more customers. And hence, this is the second part of the story. So knowing that we were expert, because we're a software company, and so we're able to essentially take these different businesses, merge them together, make them greater whole than the sum of the parts. So we did it again. And this time we bought a series of companies that all sell traffic. And traffic is essentially just the people surfing the internet. And the idea is that companies who are online need to have a service provider that can identify, of all these people surfing the internet, which ones would want to buy my product. So which ones have the intent to buy, which ones are local to me, which ones have enough money, and so on. That's what we do, and we send them over to the company's website where they can then book an appointment or buy a pair of shoes or book a table. So the first company we acquired was a Google partner. And so Google Ads is actually the platform, the most popular advertising platform on the internet. So 4 million companies When they want to put ads on the internet to get people to come to their websites and acquire customers, they use the Google Ads platform. And Google Ads teaches you how to make an ad, how to bid for an ad space, how to calculate your return on investment. Because what Google wants to do is train all of these small businesses to work out the return on investment and say, okay, if I make a $50 margin on selling my service, and then I want to acquire customers, and 1 in every 4 customers that comes to my website actually buys from me, then I'd be happy to say spend $10 a click, because then 4 clicks will get me 1 customer. It'll cost me $40, but I'll make $50 in profit. And the idea is, once they have understood that, then they can kind of set and forget. And that creates a recurring revenue stream for them of just predictable stream of customers that come to their website, creates a predictable recurring revenue model for Google Ads, because they're collecting this money constantly. And it does the same for us as their partner, because we're the ones that are bringing them the traffic. Secondly, we then did a deal with a company with its own ad agency platform. So obviously, ad agencies represent many large companies who don't necessarily go on Google Ads and book their ads that way. They go through ad agencies, and the agencies buy the traffic directly from companies like us. And then lastly, we bought a company that was an Amazon partner. So in this case, obviously, Amazon wants people to go there and buy products and services from them, and they pay us for the traffic, or for the people that will go there when they actually buy from them. And so now we have 3 massive customers, Google Ads, Amazon, and ad agencies, all wanting to buy traffic from us, make us a very robust company with plenty of options for people to buy traffic. And then where do we get the traffic from? 2 sources. One, what we call organic traffic. So we have websites that people just know the name of, or they find it in Google search and so on. Represents about 20%. Most of our traffic we actually buy, and I will go on to explain that to you shortly. But I guess the key thing is this. In the last model, in the online presence businesses, we get a subscription payment. So every customer pays us once a year for every product. Here, in this business, every client of ours pays us every time they win a new customer. So rather than once a year, it can be multiple times a day. So clearly, it's a much bigger market, and one that we can grow much faster. Now, when we go on to market size, you can see it's a much greater market. The domain market, $7 billion a year. These online presence value-added services like website building, email, Office 365, etc., another $53 billion, a great market that we're diversifying into and growing. But the giant here, the main business of the internet, is online marketing. And that's a $616 billion market growing at 15% a year. So clearly, hardly surprising that this is the area which we're growing most rapidly in. And so you can see that whilst up until 2019, online presence was the only business that we had, and we're growing that at a very respectable 4% organic in the last 12 months. It has been completely outstripped by the massive success of our online marketing business, which has grown 100% over the last 12 months to over $530 million in revenues. The orange there you can see is adjustments we've made for companies that we have acquired. So the way we calculate organic growth, so we're absolutely clear, is we take all the companies that we owned at the end of Q3 of this year, and we look at exactly how much revenue they were making at the end of Q3 last year, whether we owned them at that time or not. And so hence that's what that orange represents there, is adjustments. So we're showing an absolute pure like-for-like comparison, totally unaffected by acquisitions. This is organic growth. Now, just to delve a little bit more into what is really making our business grow so fast. And there's 3 components to it. The first is We bought companies with long-term rolling contracts with Google Ads, with Amazon, and with ad agency platform. And and these are extremely valuable because Google Ads, obviously, Google Ads is a platform where companies can buy ads and put it on Google Search. They can buy ads and put them on YouTube. But also, since 2007, when Google bought DoubleClick, they can put them on an array of third-party publishing sites, because Google's philosophy here is monetize the internet. Don't just monetize Google Search and YouTube. Monetize every website you possibly can, because they would rather get a share of revenue from other websites than not, and build Google Ads as being the gateway to advertising on the internet. So as a result of that, they're spending over $50 billion in revenue share payments to other third-party publishers. So the publisher basically brings them the traffic, and then they bill the Google Ads advertisers, and then they pay us, the publisher's revenue share. So that's where we fit in. So we have a partner that's paying over $50 billion to companies like us. Then we have a second partner, Amazon, who is doing co-op advertising. So they're taking marketing funds from all the companies that sell products over Amazon, and they're spending another $40 billion acquiring traffic. So again, that's a partner we have under contract. And then lastly, there's ad agencies paying $70 billion. Now, we obviously don't have every ad agency under contract in the world, but we have a platform through which we can reach them. So the upshot is, two of our partners alone spend $100 billion a year on traffic, and we have 0.4% share of that spend. And what that means is, and bearing in mind the rate at which this market is growing at 15%, we can continue to grow this business at 100% a year for a couple more years, and we still won't have 1% market share. So the amount of demand for what we have to sell is just gigantic. And so the issue for us is not finding a customer with money, it's actually finding the traffic to sell them. And this is how we do it. We actually are a publishing company, but we're a software company. So in other words, unlike the Daily Mail, which has a few tech people and then a whole host of journalists, editors, illustrators, photographers, etc., we don't have any of that. We just have a lot of technologists, of software builders, because we use automation to build millions and millions of websites. And each of those websites is full of ads, and each of those websites represents different micro categories of advertising, because we are totally category neutral. So we will advertise seniors living, four-wheel drive vehicles, hair transplants, dentists, name it. We will be in that area, and we do that. And how do we do that? By producing millions of websites, which either, say for a service, we'll just have a bunch of ads for different dentists in, say, Chelsea, or else there'll be product comparisons of, say, different cordless vacuum cleaners, because those are the websites that work the easiest. So when people land on them, they're looking for a dentist in Chelsea, they'll pick one, they'll go, they'll make an appointment. They're looking for a cordless vacuum cleaner, they'll go to our site and then head off to Amazon and buy that cordless vacuum cleaner once they've made their selection on our site. So our publishing technology is enormously scalable. As I said, we only cover 10% of all the categories, but we can cover anything. So that really gives us the whole breadth of the entire advertising market at our fingertips. And so, but the question is, why do people go to these websites if they have no articles and so on? And that is because we pay to send them there. So the way we do that is this: we engage media buying companies, 150 media buying companies, to place ads where the people are, on TikTok, on Facebook, on the Daily Mail, on other websites like that. And that ad might say, family-friendly dentist in your area. And when someone clicks on that ad, it will TikTok will tell us where that person is, and we will send them to any one of the thousands of different websites for dentists that we have that relates to the dentists in their area. Then when they click on that ad, they go to the dentist website. Google charges the dentist, pays us our revenue share, and this is where the cleverness comes in here. That's how we pay our media buyers. We pay them a revenue share. So their traditional customers will say, look, here's my budget. They'll take 14% from the budget. We actually go to them and say, our budget's unlimited. You get us anybody who's a highly qualified, high intent customer that wants dental surgery, wants to book a restaurant, wants to buy shoes. We don't care. So long as they do that thing, then we will pay you. And so the end result of that is we're not only the best customer that our media buying agencies have, we're the best customer they have ever had. So they are hiring staff, they're running software, and they're continuously growing our business. And we can continuously sign up more media buyers because there are media buyers that only specialize in Hebrew language, specialize in some subsector of medical services, specialize only in TikTok advertising in Spanish and so on. So all of these media buyers, this universe of media buyers, we can continue to grow. So again, hugely scalable as we're talking about 4 billion people using the internet almost every day. Now, with that, I think you hopefully have quite a clear understanding of what we do, how we do it, how sustainable it is. But I guess the exciting part is the financial results that's delivering. So over to Michael to talk you through that.
Thank you, Ben. And to put it in the words of Nelson Mandela, who said, remember to celebrate milestones as you prepare for the road ahead. And while we still prepare to deliver the year end, Centric has already, in the course of the year, achieved quite a few remarkable milestones that we're going to go through with you over the next few slides. Starting with the top level financials. So for the first time, we recorded more than $500 million in revenue. And again, that's only after the first 9 months, revenue up 88%. Also, net revenue is now for the first time north of $100 million, 53% up to $128 million. And our adjusted EBITDA has even increased at a faster pace, basically doubling to $62 million in the first 9 months of this year. And also the other key performance indicators that we share with you every quarter are also all up materially. Adjusted EPS up 92%, operating profit on a totally different scale at almost $3 million a month, and adjusted cash flow north of $65 million. So that's more than $5 million. That's more than $7 million every month year to date. The other milestone that we've met is refinancing our bond. The interest spread, which is basically what the lenders earn on us, has been cut by 60% at the current leverage level, from 7% to 2.75%, and it could never go up to more than 3.55%, which means there is a very significant saving here. On the borrowing currency, we made the choice to go from euros to dollars, given that, in particular, as a result of the pivot into online marketing over the last couple of years, US dollars is now by far our main income currency, and therefore we've also decided to borrow in that currency, which will remove all the complexities around foreign exchange impact on the financing costs that you've observed over the last couple of quarters. So that's now a thing of the past. And also very important, in particular in difficult financial markets like today, the bond would have matured on the 4th of July 2023. However, now the maturity has been extended back to October 2026. And even though we can't imagine a more difficult financial market than 2022, if then 2026 was difficult, we've also agreed a 1-year extension so that we could push it into 2027. But as Cedric has demonstrated, that it could refinance in 2022. We are very confident that it can also refinance in 2026. Two other important features of the new loan arrangements, which will be of interest to the shareholders. Bonds typically have so-called non-call provisions. That is, you need to pay a penalty if you repay them early. This we've now removed in the new loan packages. So if, for example, the company would have fewer acquisition opportunities than its cash flow, it could actually repay part of the loan without paying any penalties. And on the other hand, if we were running into a surplus of great opportunities, we now have $100 million committed revolving credit facility, which means we could actually exploit current opportunities in the market without needing to go back to you shareholders to ask for more money, and simply go back to the bank and finance these transactions with the existing credit line. Going back to the Q3 or September year-to-date financials, the last milestone that we've now achieved is that we've literally exceeded our full year 2021 numbers already by the end of the third quarter. Revenue $526 million compared to $410 million for the full year last year. EBITDA $62 million for the first 9 months as compared to $46 million in the full year 2021. And on the operating profit, we are now already at almost 3 times the level of 2021. And that is, as we've also brought all the items below that actually translate adjusted EBITDA into operating profit under control. Depreciation down to $2.1 million. Non-cooperating expenses down to $6 million. And also the share-based expenses are now lower, which in aggregate explain the shift of the profits upwards. Moving on to the balance sheet. Here we actually see that equity is higher than at year end by more than $40 million. Cash on hand is up by more than $25 million, and net debt is actually down. And that despite the fact that we've still borrowed additional money in March to finance the acquisition of Vergleich.org, the leading product review portal in the German-speaking countries, and recently Aporia, which we just acquired before quarter end, which means that despite us investing in further M&A, we can still deliver at the same time. And the question is, why is that? And the answer we see on the cash flow statement. So here on this slide 19, you see the operating cash flow under IFRS. Totally no adjustments here. The operating cash flow has more than doubled from around $25 million in the first 9 months last year to now $58 million in the first 9 months this year, which again is notably more than the entire operating cash flow of 2021. And given that these numbers are also influenced by the M&A activity, like charges pertaining to it, or certain working capital items which come with the acquired companies, we've done in all quarters back to 2019 present you with this adjusted cash flow bridge, where we basically neutralize the impact of the M&A activity on our cash conversion, and are happy to show that despite the materially accelerated growth, we are still delivering north of 100% cash conversion, and again more cash flow than for the entire year 2021. And this was an ask by investors. We've also now expanded this table down to free cash flow. So basically what is left after interest paid, taxes paid, investments, etc. And I'm also happy to show that here we are still at a conversion rate of almost 80%, where many other businesses are rather close to zero on this metric. And this basically explains why we can constantly acquire great assets to expand the strategic capabilities of our business and still deleverage at the same time. Then on this slide, we're addressing a few items which are a bit particular to CENTRALNIC, or generally maybe to companies that are highly acquisitive. So our operational expenditure growth rate is something that we've always highlighted. However, the reasons to highlight it are diminishing, given that now the growth of this item has come down compared to prior reporting periods. And also here, just like in prior reporting periods, most of the increase in operational expenditure is coming from the 6 acquisitions that we've completed between the end of the prior year comparison period and the end of this reporting period. The second item is the amortization of intangible assets. So this item is increasing because after each acquisition, we need to allocate part of the purchase price to certain intangible assets like customer relationships, assembled workforce, trademarks, internally developed software, etc. However, while we need to amortize it under IFRS, we don't have to go back and buy the customer relationships again. We don't have to buy or rehire the workforce. We don't have to buy our trademarks again. And this is why this item is not indicative of any cash outflow in this period nor any future period. And this is also why all analysts who cover our share unanimously strip this out of their profit figures. The third item, non-core operating expenses. These are basically expenses to run our M&A program, including all stages, identifying the targets, doing the due diligence, drafting the contracts, and restructuring the businesses to make part of the CENTRALNIC ecosystem. And here, at the end of last year, Ben and I have made a covenant to bring this figure down to 10% or less of EBITDA. And as you can tell here, we've not only met this covenant, but we've also reduced the absolute amount of these expenses, despite, as you will have seen, a quite active deal roadmap. We just mentioned 6 acquisitions since the end of September last year. And then we come to the finance cost item. So the finance costs that you're seeing in the first 9 months this year are not what you should expect going forward, not only because of the refinancing that we've explained to you a few slides earlier, but also in this period, we were still being hit by FX impact, so foreign exchange impact, from the wild currency swings that we're seeing this year so far. And also given that we've refinanced early under IFRS, you actually capitalize the arrangement fees of a bond and write it off. And given that we've chosen to refinance early, we had to accelerate the amortization of these arrangement fees, which is also now sitting in this period. Going forward, you can basically use the data that we've provided on the refinancing slides to make a very good estimate of what our future interest charges will be, given that now all these complexities, like for example, foreign exchange changes, will not occur anymore in the financing cost. With this, we end the financial section of this report, and I hand back over to Ben, who will run you through strategy and the outlook.
Thanks very much, Michael. Here we go. So clearly our number one focus is on organic growth in all its forms of winning new customers, launching new products, cross-selling, but also really crucially here, using artificial intelligence to optimize our services, which means to extract more money for the traffic that we can deliver to advertisers. Operating leverage, as we've already demonstrated, has vastly improved, and this is really because of us having relatively fixed costs compared to revenues that can increase by pumping many more transactions through our platform. And we expect that to continue in future. Our acquisition program has got us to where we are today, and we're very good at it. We've completed 21 transactions. We're a value buyer, and we've been proven that time and time again that we extract fantastic value from the companies that we buy. And we are an excellent buyer because, and one of the reasons being that we do business with almost every company in our industry. And so we have a warm introduction, and we can ideally circumvent any formal competitive sale process and just get the best companies into our group. And then lastly, to keep our debt sustainable, we're approaching 1 time net debt to EBITDA ratio after being at 2.5 times only a couple of years ago. So clearly, as the company throws off enough cash to both make acquisitions and improve our net debt position, we intend absolutely to continue to do so. And again, our interest coverage is north of 5 times. It's an area that we believe investors are very comfortable with, and we would want to stay around there moving forward. Now, in addition to all of those objectives, we have ESG objectives, which are very important to us because we believe that the responsible company of the future will achieve growth that is both sustainable and inclusive. And so we're there right now. Our actual mission statement is making the internet everybody's domain, and we are succeeding in having customers in almost every country in the world. And it isn't just that we're extracting money from our customers, we're actually providing them with a great service, allowing them to build their own corner of the internet and to monetize that and to spread the benefits of the internet all over the world. Our workforce is extremely diverse, and we are very focused in maintaining and increasing that. We have a grant project where we have donated already 600,000 euros, and we expect that to increase over the next couple of years to over €1 million to worthy projects, software projects, helping cybersecurity, helping accessibility for the disabled to the internet, helping with education in the internet, and other such worthy causes. And then lastly, we were a real early adopter of carbon neutrality. We first declared ourselves carbon neutral back in 2012. We did a whole lot of acquisitions of companies that weren't carbon neutral, so we've had to bring them all in line, which we did by the year 2020. So through a combination of carbon reduction and carbon offset payments, we're again carbon neutral and will intend to continue in that vein. So what does the future hold? We've made it clear we expect to trade in line through to the end of the year, or at the actual very, very top of the numbers in the market, noting that those numbers have been upgraded 4 times already this year, 6 times in the last 18 months. The direction we're showing is very clear that profits will improve, scale will improve as we move forward. And we'll have more of that for you on the 30th of January when we have the full year update. But in the meantime, I guess the key points to take away is we have proven strong performance, sustainable growth, and the potential of our marketplace model to deliver excellent results. And we obviously plan to continue to do so. There are online privacy measures that affect us only in a good way because we knew they were coming. We knew GDPR. GDPR was already here before we started getting into online marketing, and third-party cookie bans and so on were already on the horizon before we started here. Our pipeline of future acquisitions is healthy, and essentially our cash position only gets stronger and stronger as we continue to throw off more and more cash. So with that, thank you very much for listening. We have a couple of minutes now for questions, so over to our moderator.
Ben, that's great. Michael as well, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Ben, Michael, as you can see in the Q&A tab there, we have received a number of questions during your presentation this afternoon. So thank you to everyone on the call for taking the time to submit their questions. And guys, if I could just hand back to you to make your way through that channel there to respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Very good. So let's just jump through this. So the first question is about the slow growth of online presence, and do we do price rises? So yes, the answer is yes, we definitely do price rises. It's always been an inflationary area, but because the largest part of our that business has a lot of contractual pricing. So we supply big companies like Google and GoDaddy and Johnson Johnson, so on with domain names. It isn't something where we can just slip in a slight price rise. They're actually contracted multi-year price protected programs. So we don't have quite the amount of flexibility that, say, someone that's only selling to small business has. But yes, and honestly, that business has suffered quite a lot through the through forex changes in forex as well. Next question on SGSDG. Could you give us some background on what we've done? I think I kind of gave you a fair amount of background about things we've done in that. We also publish a fairly comprehensive description in our annual report. If you're interested in that, you can just download it from the website. If you still have any questions, feel free to just contact us directly. With the continuing large rises in revenue, can you explain why net profit is down 6% from the half-year results? Michael, do you want to?
Right. That is basically owed to two factors. First, additional amortization. Now that we have for the first that we've based for more months had to amortize the latest acquisitions, both of Aporia and VGL, which we explained before, which is an item which is totally non-cash. However, it's in accounting, it eats up a lot of the profits, even though it's totally not relevant to the cash flow or the leverage or future ability to pay money to shareholders. And we also had these one-off items that we explained before on the refinancing, like writing off the capitalized arrangement fees of the bond, given that we've refinanced it early, and also the FX impact that we explained, why the finance cost in the third quarter is not representative of the ongoing financing cost, which made that on an accounting basis, yes, the profit after tax is down from 6.9 at the end of the H1 to 6.5. But when you look at cash flow, which is, in our opinion, a much better metric of looking at how good the business is performing, we've actually delivered much more cash flow after Q3 than we did after the first half of the year.
Very good, thanks, Michael. So the next question is about, can we explain how the revenue arises and how working capital movements work? I know that's quite a complex question, but I guess the summary is our online presence products are subscription products. Our online marketing is more like a utility where we have a contract with someone, and under that contract, they continuously use our services and continuously accrue a liability to us, which they then have to pay us on a regular basis, typically monthly, or else some of it is prepaid depending on the customer. So, large customers like Google pay us on a monthly basis. Others actually do pre-fund their accounts before they can work with us. So that probably explains working capital movements because we got a blend of those two types of payments, some prepaid and others from large enterprise customers paid on a kind of monthly basis. Have I covered that? Do you think, Michael?
Yes, I think that's fair.
Very good. So it seems like the market doesn't believe in CentralNic. What we do exist. Why do you think that is? Is there a feeling out there that you're a flash in the pan and not long-term sustainable? Who knows? Yeah, I'm sure there are some people that might think that, although we have been listed for 9 years and grown at a CAGR of 78% year in, year out for the last 9 years. So that's a pretty durable flash, and anyone who jumped on in early days has made a lot of money. We were trading at 40p when we did an equity raise at one point. So I'd say what is the issue? The issue is this: we're a tech company, and compared to our peers, we're going fantastically well. We're maybe 20% down from our all-time high, whereas many of our peers are up to 90% down from where they were last year. So and why? I guess unfortunately we're somewhat the victims of our own success in that large institutions that invest in software companies and British small caps are constantly in need of liquidity, and so they are selling down our shares at the moment just because they get much more money for our shares than they do for anything else in their portfolio. So it's a downward pressure comes from that, but we have been enormously resilient compared to our peers here and in the United States and all over the world. But look, are we really cheap? Yes, and obviously that's great news for investors just learning about our story. Let me keep going down. Or are you just not understood? I think the other thing is you've seen how fast our online marketing business has grown. This is from 2020. Say January 1, 2020, essentially zero. Now over $500 million, 3/4 of the way through 2023. So I guess we took a lot of people by surprise. And people that said, "Oh no, I know about that company," have been very surprised when they find out what we do now. All right. Is anyone else consolidating in the space? Yes, they are. There's a number of PE-backed consolidation plays in the space, as well as a couple of listed ones, but mostly PE-backed. I'd say there might be at least 6. When are you expecting to review 2023 and 20? I'm sure it means 24 forecasts. Well, we review them all the time. They were recently upgraded in the last month. And so what tends to happen is whenever we put out new results and we beat the expectations, people upgrade. And so you can expect to continue to see that. Next question. Will we see gross revenue of over $1 billion in 2023? Well, that sounds like the kind of thing I'm not supposed to be projecting, but I hope so. And there's certainly positive indicators that at the very least we could achieve maybe $1 billion run rate during next year if you project forward. But that's not an official projection. So what are the barriers to entry for your business model, and can they be easily replicated? If not, why not? No, it's very hard. There's maybe in terms of our contracts with companies like Google, like Amazon, and so on, there are not many such contracts with such great terms because they are long contracts. We're based on a lot of trust and building a huge amount of volume with those companies. Our technical platform, I wouldn't say it's unique, but it would be incredibly hard to copy. Again, there's 10 years of work in that, and our domain name business often relies on people wanting to get into the industry because we actually provide them with all the tools to get into the industry. So in that way, people who want to compete actually are the ones that we want to bring in because they help us. Question here, Michael, is it 90-day SOFR and the same as it was?
It's daily SOFR, and we've swapped 50% of it at an average of 3.92%, so very close to the current market for the next 4 years. So the risk of interest rates running away is quite limited.
Okay, now that's a question about integration. We do integrate different brands together, but we tend to do it very slowly and carefully because we just hate losing customers. So it tends to be a slow process. CENTRALNIC is more of an investor-facing brand. We have all kinds of brands like Only Domains, Instra, I Want My Name, Team Internet, Parking Crew, Zero Park, Vergleich.org, etc. But we have a very sophisticated and complex integration scheme with, I think, over 25 different workflows for integrating companies into head office and companies into each other. And but the reality is it's slow. We're very focused on growth comes number one. Integration is more of plays a supporting role, but we definitely are focused on getting efficient, more and more efficient all the time. Michael, there's a question about, does integration influence treatment of goodwill? I don't think it does it? Because it's more about following schedules.
Exactly, not necessarily, or I would say more likely not. And as we explained before on amortization of intangible assets, so tangible things like trademarks are capitalized separately. If we would then give up one trademark, we would need to write it off. Whereas the goodwill is basically what's left over, and here we only need to test whether the profits delivered by the business still justify it, or if you combine two businesses, whether the combined cash flow of the two businesses still justifies a combined goodwill. And this is the test that we constantly run on every quarter end. But as you've seen, no particular issues here.
Yeah. All right. So the next question is pointing out that the analyst growth rates are far, far lower than our recent historical growth rates in terms of the projections, and trying to ask how come. And I guess the answer is we do provide guidance to the analysts, but we are always very conservative. We want to build in all of the possible things that could go wrong, not because we're seeing them, but because we know they're there. We know there's a war. We know there's massive inflation. We know it's difficult to hire great engineers at the moment. And there are supply chain issues not really affecting us so far because we're completely online, but we just don't have the hubris to say, yeah, that's all gonna never affect us. So our philosophy, as I guess, having been a CEO of a listed company now for almost 10 years, is, put a number in the market that you can beat and raise. Do not disappoint ever. And so that's been our approach. And there's just too much volatility out there to really project that there's no doubt that we're going to continue to grow at this rate. But so I know it looks odd to have much lower projections than we have existing rates, but existing growth rates, but that's the reason why. So the annual accounts refer to CENTRALNIC becoming $1 billion business. Have the business set any revenue targets for, say, the next 1, 3, 5 years? Yes, we have, and our internal targets are obviously higher than the analyst targets because that's the nature of targets. We want to beat expectations, but we can't share them. All right. Can you please indicate whether you're trying to increase the share of value-added service revenue in the online presence segment? And if so, what do you think you can get as a percentage of revenue in that division? Yes, we are. It's been a slow, hard road because the companies we've bought have just been pure play domain companies as a rule. But if you look at much more mature companies that do this, they have up to 50% revenues coming from this. And in fact, we own one of those companies, a small business in Australia that does sell Office 365 and all kinds of hosting and so on, and that's delivering a more than 60% of the revenues. Okay, another question about the value of the shares. I think we've gone into that already. With rising interest rates, what's happening to vendor pricing expectations when you're looking at acquisitions? It isn't really a matter of interest rates. It's a matter of more the collapse of the valuation of tech companies, which is helping us. Do we have to stop or will we finish?
So you have as long as you need, sir.
All right, we might as well finish these questions. I don't like to disappoint. So would it be fair to say that online marketing is about improving the quality of the traffic you buy and reselling it at a higher price? Maybe. I mean, it's also selecting the traffic that we buy, finding the best offer for it. So there's actually a lot of, there's like 10 years of development of machine learning tools in order to do that. So that might be a incredibly high level simplified way of doing it, of describing it. But you could also say that we're sorting through all the traffic to find the most high intent buyers and matching them with the best offers for the products and services that they want. Would be another way of describing it. Next question. Can you explain more explicitly what are the key determinants in maintaining the high levels of organic growth in the online marketing segment? I think I pretty much explained it. So on the one hand, having partners that have a massive appetite will buy any great traffic that we have to offer them. Secondly, making sure that we have a software platform that can manage all the traffic and all the ads and connect them up, which we do. And then lastly, the endless opportunities with media buying, where we currently cover about 500 of the 5,000 different ad categories and only in a few languages and only in a limited number of countries. So there's so essentially all of that remains as great potential to increase. Next question. Could you provide some details on your board and how diverse it is? Sure. So we have how many people do we have on the board? 8. And I'm not sure how to. So we have, I think it would be safe to say, one woman and one person of color on the board at this stage. But it's evolving. Have you considered relisting in the US? Yes, we have several times. Most of our big business partners are listed in the US, and so we're it's something we look at, but we are still a very small company for US. It's 700 million for NASDAQ and so on. It's very small, and we'd have to say, whilst we're not valued at where we ought to be today, AIM has been good to us and allowed us to grow from 3 million to 700 million in revenues. So, we'd be churlish to complain about that. Why? All right, next question. Why is GoDaddy growing at 7%, 9% constant currency, and your domain business is growing at 4.3%? I mean, GoDaddy has 50% market share in the United States. They're operating at a much greater scale than us, so they're 20 times bigger than us. And I guess, in a difficult market, being the dominant brand in the world's largest market means that it's easier for you to win customers and grow than being a kind of challenger brand in a global market. They're a great company, and we're absolutely delighted that they're business partners of ours. And obviously we do look at them for examples of how to do things very well and learn. Very good. Last thing, thanks for your good work. All the best for the coming days, weeks, years. Well, that's appreciated. Thank you, Gregor, for that one. Look, so thank you all for those great questions. Apologies for really rushing through them, but I thought better to try and address them all than leave some people feeling like their questions went unanswered. Plenty of information in our annual report in particular, although obviously it's a year out of date because it's a year old. And we do try and do a fairly regular investor meets company presentations. So I think you can expect another one in the early part of next year if you'd like to continue to follow our story. So thank you very much, everybody, for your participation for what turned out to be quite a long session, and thank you to the team for organising this.
Ben, Michael, that's great. And thank you very much indeed for being so generous of your time then, addressing every single question that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses, of course, where it's appropriate to do so. Ben, I was just going to ask you for those closing comments, but I think you well delivered those just now. So unless there's anything further to add, sir, what I'll do is I'll redirect those on the call for their feedback, which I know is particularly important to yourself and the company. So if there is anything to add, sir.
Yeah, I would just say we absolutely read every piece of feedback and we really take it on board. So if there's anything that we could do to make things clearer, to help explain the investment case and so on, please, it won't be wasted if you take the trouble to share criticisms or suggestions. We pay a lot of attention. So thank you very much, all of you.
Ben, that's great. Thank you very much for that. And Michael as well. Thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CentralNic Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.